Strong non-farm payrolls give the dollar a boost. A flash crash in gold signals tapering may be coming, and bond markets await key CPI data this week. All this and more in this week's Macro Insight. Okay, so welcome to Macro Insight, everyone. Welcome to the new trialers. Welcome to the guys who did the Intro to Options course at the weekend. And today is the 10th of August. Let's take a look at markets. So what do we have going on in markets? Last week, equities continued its kind of low vol drift higher as we head towards August expiry, which is third Friday of the month. So it's not this week, but next Friday. And the market seems to be stuck in another kind of flood of gamma and choking on that time decay. And it really can't shake that loose. So the S&P really struggling to move and you know, very little move in equity markets in general in the broad indices on the back of that non-farms print on Friday, right? So we're definitely still stuck in the range on S&P. And if you look at that non-farms print on Friday, there was some seasonal adjustments in there where normally you get a bunch of job losses from the educational sector, but you basically didn't get those losses because a lot of people had already lost jobs due to the pandemic and stuff like that. So a few little things in that number that maybe mean it's not quite as strong as it looked, basically. Yeah. So when you're losing less jobs than you normally lose, and you're showing that as a positive, the market takes that as a strong number. It's a little bit suspect, that is potentially, right? So I'm not so sure the market's reaction, certainly the bond market reaction, I'm not sure is as warranted on that actual particular print, but remains to be seen. I mean, bond markets arguably were a little bit overbought and they needed a bit of a pullback, and that's what we got. Okay, let me share my screen. So here's your S&P. So we had a very minor blip down to that support that had been holding in that 43.70 area. That held again, and then we spend the rest of the week in this sort of rising channel, of which literally it's about 1% wide, right? So it's drifting higher, sure, but I mean, that's not a lot of movement on the S&P, yeah. So realized vol, you know, very much remaining stuck in the single digits. And, you know, if we look at VIX, you can see here, 10-day realized at 7.5, VIX back on a 16 handle, and that curve, you know, coming down in its normal contango sort of fashion with August a little bit above 18 right now. Now, last week we had been saying that despite a realized vol of around 10 or 11, VIX was holding up pretty well. And we were blaming that on the idea that the VIX was capturing Jackson Hole, and Jackson Hole was being deemed an event, a noteworthy event that might induce some volatility. And I would say, as we've gone on through the week, the market's maybe starting to price a bit of that out. Now, the fact that the market just can't move, that helps vol come in, right? There's a limit to how much theta dealers are willing to pay, and they have to dump some vol because they're just choking on it. But I think Jackson Hole maybe is starting to become a little bit less important, as we've had a few signals that maybe September FOMC is the date that we really need to be keeping an eye on. And if that's the case, then right now, the 1 month window, which is what the VIX represents, that 1 month window of time, that doesn't capture the September FOMC. It captures Jackson Hole, but it doesn't capture September FOMC. So in a couple of weeks, once we go through the 21st, 22nd of August, then the 1 month window will capture that date. And you might start to see the VIX actually go elevated again as it captures what is going to be the biggest FOMC in a while. Yeah. We look at the VIX level. You can see the, we're heading back towards the bottom end of this range. Around the 15 handle was where we were finding support, a month or two ago. Didn't really manage to sort of close below there. And that seems to be where we might be headed, right? So right now we're at 16.6. We've got VIX expiry next Wednesday. We've got regular options expiry next Friday. Often, in the absence of any realized vol, you tend to see flows in the vol market that are going to push that vol down. So I would not be surprised to see VIX go back onto a 15 handle into next week. Yeah. But, if you kind of buy into the idea that September FOMC is becoming the major event that the market's waiting for, and that's going to be quite pivotal for markets, then starting to accumulate some cheap long vol exposure into any sell-off that we get over the next sort of 5 to 10 days, that could make sense. Because, and for those who have watched my videos with Spot Gamma, we talk about this cycle of realized volatility where volatility gets suppressed going into that middle of the month expiry. Then the market loses a load of gamma, and that means the market's a bit more free to move. And then often, if there's a big month-end expiry, which there sometimes is, that we're not always, can't always see in the listed market, but sometimes in the OTC market, there are big month-end expiries, you often get a bit of suppression of vol going into that month-end as well. But there tends to be this cycle. So I would say picking up some cheap vol into the end of this week, early next week, if that's what we get, with a view to seeing a vol spike over the following week or two as we go into the back end of August. I think that's kind of how the setup looks right now. I think that looks sensible. Okay, so that's kind of where we are on S&P and volatility markets, or index volatility. In terms of what else has been going on, obviously we've had a lot of earnings, right? We're kind of coming towards the end of earnings. Earnings are generally very strong. So we've got more beats on earnings. And, we're talking about 1 sigma higher than average, which is pretty strong. Yeah. But the broad market didn't really seem to care that much, right? So you look at where the S&P is, yes, we're a bit higher, but we're not really getting any big market moves on earnings coming in that much better. So that kind of signals that a lot of that was kind of in the price and was already expected. What we have been getting, though, is quite a bit of sector dispersion. Yeah. So if you look at this chart, every week I have a look at what all the different sectors are doing. So this kind of shows you on the week what various different sectors have done. And you can see, you've got financials there leading the pack at up around 4% on the week with XLF, which I had said, I thought was quite a good one to buy, especially if you thought yields were going to bounce. Utilities also up about 2%. Got a load of people in the middle of the pack, plus or minus 1%. And then you've got energies down a little over 1%, and you've got metals and mining down about 3%. Yeah, it's a decent amount of dispersion across sectors, even though the broader market can't really move more than 1%. So something to be aware of under the surface. There's lots going on. Now that level of dispersion often happens when you see quite a lot of interest rate volatility. So as we're seeing, sectors being quite interest rate sensitive, then when we do get a decent move in rates, then you often see a bit of dispersion under the hood there, basically. Yeah. Now we've got the Delta variant, obviously has been popping up, but we're hearing, from a few people who model this, that the US is likely to peak pretty soon, if they haven't already, in terms of the Delta. And obviously we've seen the peaks in the UK, and things like that. So really the main focus for the market, I'd say, has gone past Delta and is probably more about inflation, right? So we've got inflation print this week, CPI, everyone's going to have their eyes on that. And after the strong non-farm print on Friday and hawkish Fed comments, people are basically thinking that tapering's on the table for September. So it's all about the marginal data that's going to make you think that tapering's a done deal or not, basically. And that's what's going to be driving asset markets. And that focus on inflation is really going to intensify over the next few weeks, I believe. Yeah. And if we look at inflation, what's been going on in inflation and the inflation story, obviously it's that whole, is it transitory, is it not? That's what everyone's trying to figure out. And, there's a few decent charts here to share. So, we've got various metrics people look at to try and get a read on what inflation is doing. So you look under the hood of inflation, you've got things like used car prices, prices paid surveys, commodities, delivery times, supply delivery times, obviously gasoline, flatbed rates, things like that. So for trucking. So that does look, a lot of those things, if you look at this kind of index or this weighted average of those 6 measures, those things look that they may have well peaked in May or June. Okay, so definitely a sign there from like a lot of the main things that drive these inflation numbers looks like they've peaked in May and June. Okay, but then the counter argument to people who are looking at that is to say that yes, those things might be coming back down, but there are things that are going up that are going to counteract that and offset that fall. So overall, you're going to see persistently high inflation. And the main thing that's coming up there is rent. So you've got rent and you've got wages. Wage inflation, debatable how much of that we're actually going to see. I think that's quite a complex one. But basically, here you've got rent, right? And you've got various data showing you that the growth rate in rent is way above trend. Obviously, house prices we know have gone ballistic and rent usually lags that. And you've got a massive tightness in the market. So you look at US apartments and how tight the supply is, that usually gives you an indication of where rents are headed. It's a bit of a lead indicator there. So you've got really, really tight market in apartments, basically in the US. So that would suggest that rents are going higher and they're going to stay higher for a while. And is that going to offset any of the rollover in some of these other inflation things that are going on? So on the back of that, those two arguments, what does the market think? And, for that, you need to look at inflation markets, and inflation markets are starting to sympathize with the idea that inflation may well persist. Yeah. So you look here, you've got 1 year inflation swaps, 2 year, 1 year inflation swaps. So those are signaling inflation in the future. What does it look like? And we're seeing a bottoming out of those inflation swap markets. Yeah. So and those guys, that is their day job, right? To trade inflation and forward inflation and things like that. So they're looking at all of the data that's coming in on inflation. And despite seeing what is looking obvious, like those metrics that have peaked in May, June, well, the actual inflation markets are starting to move in the opposite direction and go back up again. So I think that's quite telling and that's quite interesting. Okay. And then a couple more charts I just want to show on that. People who are against the idea of inflation are saying, well, if we get no loan growth, how are we going to get inflation? Okay. And, you've got this from the Fred website. I think it's the St. Louis Fed, right? Yeah, St. Louis Fed website. This is showing us commercial and industrial loans, all commercial banks, and that's going nowhere, basically. Okay, so if you've got no loan growth, then there's no money actually being created that can then go towards spending and really creating sustainable inflation. Now, that argument, I think, would hold if we were looking for if we're saying, only consumer demand-led inflation is what we're going to see, basically, right? The flip side is that a lot of the inflation is not due to demand-led. Yeah, we know that there was a bit of a spending boom over the summer that was expected, savings rates have gone up and stuff like that. But the real worry on inflation, I think, needs to come from the idea that these supply chain bottlenecks aren't going away. Yeah, and they're not going away as fast as you would have hoped, right? So if you look at container rates, I mean, these are absolutely insane. Yeah, look at where they were, right? There were 2 to 3K, right, for a period from 2018, 19, 20, and they're now, 6-7 times that. Okay, and that is, I mean, that's just not showing any signs of coming back. And you look at China shut down half their country, right? That is going to impact things like this. Yeah. So I don't know if we're going to have to live with COVID and some kind of restrictions are going to remain. It's going to create frictions on this type of stuff, moving goods around the world, basically, right? And that is going to mean prices remain elevated for a lot of things. Even if the consumer isn't necessarily out there spending with more money in their pocket, that doesn't mean the price of everything's going to come crashing down necessarily, right? So these are basically all of the arguments on inflation. You can take in all of that and make your own decision, basically, right? But I'm definitely seeing signs of more persistent inflation, even if it's not coming from the demand side. And that would lead to a more stagflationary environment where growth slows down, but prices stay up. That's not a great place to be, I don't think, basically, right? And that could be where we're headed over coming months, I think. Now, when people say stagflation, I'm not saying we get negative growth necessarily. It's more a slowing of growth we get, but prices don't really come off, right? Prices stay high and maybe we continue to see higher and higher prices. I think that's definitely a big risk, okay? And then the last chart I just want to show is, how much do markets care about inflation? So if we look at this, so this chart shows us financial market volatility. And for that you're looking at 30-year bond yields, S&P, VIX, currencies, and high yield corporate yields. And it's basically looking at the correlation of those things with inflation expectations, okay? And you basically saw that correlation go up quite a bit earlier on in the year, and then it came crashing back down. So after the FOMC in June, where the Fed was a hawkish surprise, they showed us that actually they are watching inflation, they do care about inflation. Any inflationary data or expectations were kind of met with the expectation that the Fed's going to basically do something, right? The Fed's going to taper. And so asset price volatility was kind of cushioned. When you saw inflationary data, it's like, okay, well, the Fed's reaction function does care about that. And so whatever they do is going to offset that, right? So that's, I think, the reason and the explanation for that sort of lowering of correlation. And now I just think, now that the slower growth recovery seems to be priced into bond markets to an extent, then we may see this correlation increase again, right? And you might see volatility go up as you get more inflationary data, basically, right? So, and you look at that, it's quite mean reverting, that correlation, right? So when it gets low, minus 0.5 is quite low. So it often does then tend to bounce and revert back the other way. So we've had a period of, that correlation go down between inflation expectations and market volatility. And I think that's going to tick up again. And if that does tick up, then, if you think you're going to see inflationary data persist, then that's going to bring market volatility with it. Then there's an opportunity there to maybe buy some volatility, right? Because, volatility is starting to get back towards that low end of the range that it's been in. Yeah. So those are my sort of observations and thoughts on inflation and how it's going to kind of filter through to sort of market volatility going forward. And then the last thing I'd mention is hedge fund leverage is at peak levels, right? So because the equity market has been so kind of, able to climb the wall of worry and not really care, we've found ourselves in a place where hedge fund leverage is pretty high. And what could possibly go wrong when hedge fund leverage gets a bit high, right? So don't be surprised if you see some unwind of that leverage, because we do get some volatility that comes in the next month or so, okay? So that's kind of that. And then, so coming up this week, main focus, US CPI, that's on Wednesday. Outside of that, you've got UK GDP numbers out Thursday, industrial production out of Europe, PPI out of the US, and then you've got a bunch of commodity reports, like monthly reports out of the IEA and OPEC. So you get a feel for the oil market there. You also got some reports out from the agricultural commodities, right, to give us a sense of what the crop yields and things like that are, right? So that might give us a move out of some of those ags. But we'll talk a bit more when we look at the charts on commodities. And then finally, Michigan sentiment in the US on Friday. So that's kind of what to expect and what's coming up this week. So dollar. So King Dollar, what's it been up to? So yeah, on non-farms, that we had a pullback before that in the dollar, and that was from a relatively dovish FOMC in July. So we hit those levels of 93. We pulled back. We bounced off key support at 91.80. And then we got the catalyst of a strong non-farm print to then take the dollar back up again, basically. So we're retesting the highs in DXY. Now the CPI this week could give us the catalyst that we need to break higher and actually go through that 93.5 area, which I saw as a major resistance zone. Now, personally, I think the move in bond yields has been large enough, and the expectation of a large CPI print is already baked in to some extent. So I think you'd need to see a huge number to break the dollar and bond yields significantly higher, in my opinion, than where they are now. So if we look at bond yields, so this is the dollar back to its highs. If we look at bond yields, look at the 10-year, you know, that downtrend is still very much intact in the 10-year. Yes, it's had a bounce off that sort of double bottom area. But, you know, I would say it can still get up to 140 and be in a downtrend, right? So I don't really think that trend has reversed just yet. 30-year, I'd say even more so. The downtrend in the 30-year is even stronger. Arguably, that's not even going to get above 2%. And the reason I say that is because even if we get inflationary data and you get a pop in yields, what you're seeing in the curve, right? You're seeing more and more flattening of the curve every time we get something that's going to trigger a Fed tapering. So that means even if you get a strong CPI and bonds sell off, that's coming from the belly of the curve, right? That's coming from the 5-year stuff, right? That's the thing that's going to move a lot. And then your 5s, 30s doesn't need to do anything, right? This is the 530s from last week, okay? That's not really steepened up very much. Right. So I think the risk reward of being long bonds in the 30-year is setting up pretty good, because if you do get an inflation print that isn't that high, then bonds probably bounce. If you get an inflation print that is high, it's already kind of expected to be high. And, you know, the market always likes to say, oh, it's transitory or whatever. And even if it's not transitory and it triggers a Fed tapering, what does that do to the curve? Flattens the curve, which means the 30-year doesn't need to sell off that much. So I would say the long end of the bond curve is presenting a reasonably good opportunity to get into. And actually, I even put some of the dry powder that I had in cash in my long-term pension portfolio. I did buy a clip of that TLT basically yesterday. For that reason, basically, I do think it makes sense to have some of that in the portfolio. Yeah. So those are my thoughts on kind of bonds and the dollar. Now, if we go to commodities, so I wonder what I'm going to talk about in commodities. So obviously, let's start with gold, because that's where the action has been. So I had flagged gold on Friday as a bit of a no-brainer for non-farms, right? And the logic there had been, for those who weren't on the Telegram chat or didn't see it, the logic there was, well, I don't think equity is necessarily going to move that much on non-farms, but gold loves a move on non-farms. If you look back at all of the previous non-farms, gold often tends to have some of its biggest moves on non-farm payrolls days, okay? And then in the run-up to that as well, last week, we were seeing gold trying to break 1830 and get slammed back down to 1800. And that happened a couple of times, right? So, you know, if we bring up the shorter dated charts, we can show that in gold. So here, you know, you had up to 1830 slam back down, up to 1830 slam back down. So gold was exhibiting price action that was saying to me, well, it's not very stable, right? It's not at a place of equilibrium. It doesn't really know where it wants to go, and it's winging around quite a lot. So that's a good starting point when you're thinking about buying volatility, okay? Then I was looking at gold and saying, okay, normally it likes a move on non-farms. So what is the price of the one-day straddle? So I looked at what that was. So we were trading at 1800, and the 1800 straddle expiring at the end of Friday was worth 13 points. So 13 points was less than a 1% move on gold. It had already been winging around by, you know, on average 15 to 20 points a day anyway. And on a day of non-farms with a major catalyst, it was only priced to move 13 points. So to me, that didn't really add up. So I bought, and then but instead of buying that straddle, I compared it to the price of the strangle, which was 10 points out, to the 1790, 1810 strangle, which was costing about 5.7. So I thought rather than buy the straddle, I'd buy the strangle. I'll be able to afford more of them because they're cheaper in price. And if I get a nice big move out of gold, I've got more leverage to my premium, basically, right? So that was the thought process. That was why I did the trade. I paid 5.7 for it. By the end of the day, it expired worth 29. So, you know, not bad, right? It's probably, that's nearly 5 times your money, basically, right? So that those sort of things don't come along that often. So that was a good one. Now, ironically, I wish I'd bought a 2-day straddle. Not that you can buy a 2-day straddle that easily on these platforms. But so what do we get after the weekend? So after the weekend, we got a break below this key support zone at 1750 and an absolute collapse. Right now, it was very thin volumes on a Sunday night. Apparently $4 billion worth of selling was done. There was big sell orders, and you had Singapore and Japan closed. So you had a bit of a confluence of factors there: low liquidity, big support level taken out, and someone wanting to sell a shitload of gold, right? So that took us down. And that did, because there was nothing else really going on the macro spectrum. Like if you looked at where bonds were, looked at what equities were doing, there was nothing really going on. So you could kind of put that down to idiosyncratic, you know, factors within the gold market and silver, because silver kind of moves in line with gold, right? So it did seem to be precious metals specific. It did look like an overreaction because there was low liquidity. So it kind of did make sense to try and buy the dip if you had the firepower or the dry powder to do that, right? So I did put a tactical purchase on down there at 1700 in gold. Thankfully, I was able to flip that out the morning after. Same thing with silver, picked up some silver at 23. So, you know, but like I say, the reasoning behind it was we were bouncing off a key level on gold there at 1680. It did look like an overreaction in the price, and there wasn't other things backing up that move, basically, right? So when there's one thing that's moving too much due to technical factors like a massive seller on low liquidity, and you haven't got the whole other sort of spectrum of macro assets kind of telling you the same story, then it sets up as a reasonable sort of tactical trade, basically, right? So that was the thought process behind that. Okay, I mean, we had some hawkish comments from the Fed as well, that signaling tapering announcements might be coming. So there are reasons why the gold market is bearish right now, but that just did look like too much of an overreaction, basically. What else? So the technical picture now doesn't look great, right? So 1750, 60 area is going to act as resistance now, whereas it was previous support. You know, we'll definitely need to get back above there if gold's going to get bullish again. And obviously you'd need to see real yields go back down, because real yields had a pop as well, right? So that was kind of helping the gold sell off, the fact that real yields popped. So, you know, the market seems to be pricing in a high probability of Fed tapering pretty soon, sooner rather than later, in which case, you know, that downside support could be at risk, right? That 1680 level on gold, maybe that isn't the bottom on gold if we get our taper announcement, right? That the market is now gunning for. If they do get that taper announcement, I would argue your next area of support is around 1550 on gold. Okay, so that's probably as low as we're going to go in this sort of next major move if it's to the downside. And you probably expect to see some sort of bounce off 1550 if we get there. If, however, you think the Fed tightening, if it comes as a policy error, right? Or you just believe that they're just talking up tapering, but they're not actually going to deliver tapering, then these sort of entry points in gold are amazing on a long-term horizon, basically, right? So, picking up some gold anywhere around 1680, and if it gets to 1550, if your belief is that they're going to have to reverse course because they're going to screw up the growth prospects of the economy and things like that, like tends to happen, then buying into that on a longer term time frame is not a bad idea. Yeah, just be prepared to stomach some volatility if you do that, basically, is what I would say. On that whole idea of buying call options out to March next year, I was waiting for gold to pop its head back above that 1830-40 area. It didn't manage it. I was going to use that as confirmation to buy those calls. We're going to be waiting a while for that, right? So there's no real reason to worry too much about that. Gold needs to do a lot of work to signal a more bearish outlook. So I wouldn't be in a rush to spend your premium on that stuff right now, basically. Okay, so that's gold. Quite a lot to talk about there. On silver, for those who are interested, the levels that I kind of had mapped out, 23, 22, and 20.7. We actually managed to get down to 22. I didn't even see that. That was very, very momentary, I think, an overshoot. I managed to scoop some up in the 23 area. And then, we'll see. I mean, I haven't bought massive size, so I can kind of hold on to that and see where we go. If we do get a bounce back towards 25, I'll probably take it off. That's probably how I trade it. So then oil's the other main one that's been moving, and we had some excitement in. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.